Let's jump right into this explainer. You know, earnings reports, they can usually feel like just a dry, predictable list of numbers. But every once in a while, a company posts a quarter that totally defies surface level logic. We're talking about the kind of report that signals a massive, under the hood transformation. And today, we are looking at exactly that kind of quarter for Atlas Energy Solutions. So we have to start with this central mystery of this quarter. How on earth can a company post a massive net loss? We're talking $47.3 million in the red, and yet watch its stock actually rally 3.6% right after the earnings drop. In traditional finance, right, a huge miss on the bottom line usually triggers a massive sell-off. People panic. But here, the market didn't panic at all. Instead, it rewarded them. To figure out why investors were cheering instead of, running for the exits, we need to break down exactly what went wrong in the short term and what is going so incredibly right for the long term. All right, let's address the elephant in the room, that stark Q1 net loss figure. This minus $47.3 million, it actually wasn't a structural failure of the business model at all. Honestly, it was a perfect storm, literally. Severe January winter weather completely paralyzed parts of West Texas, right at the exact time the company was hit with elevated maintenance costs at their flagship Kermit facility. That 1-2 punch pushed plant operating costs way higher than they originally expected. Throw in the fact that they had to lean heavily on expensive third-party logistics just to make sure they met their customer obligations, and, well, you have a temporary, but definitely brutal, hit to the bottom line. And honestly, this brilliantly illustrates the disconnect between looking in the rearview mirror versus looking through the windshield. If you only look in the rearview mirror, you just see the short-term pain, right? A $47.3 million net loss, adjusted EBITDA dropping near the low end of guidance. Yikes. But look through the windshield and you see the real catalyst for that 3.6% stock rally. The market looked right past those January winter storms. They zeroed in on accelerating demand, recovering margins, and most importantly, a massive, literal game-changing strategic pivot into the power sector. Now, the reality is that weather and maintenance temporarily squeezed profitability. It dropped their adjusted EBITDA margins from 15% down to 11%. Gross profit naturally took a hit as well. But here's the absolute key takeaway. Management made it crystal clear on their earnings call that these higher plant operating costs were actually already beginning to subside as the quarter progressed. So actually, scratch that panic. This margin compression was an isolated, temporary event. It is definitely not a permanent downward trend. In fact, if we look at the top line, the story completely flips on its head. Despite that ugly bottom line loss, top line revenue actually grew. It went up sequentially by 6.5% to hit $265.6 million. And that was driven by just incredible volumes. I mean, they delivered 5.7 million tons in proppant sales, and their logistics division literally hit an all-time record high with 5.5 million tons delivered. So the underlying business engine here, just moving and selling sand, was absolutely firing on all cylinders, even if those pesky temporary costs masked that success on the bottom line. And that massive momentum brings us to a really powerful reality check from their president and CEO, John Turner. He noted that the underlying commodity macro environment improved rapidly over the course of the first quarter. Because of this rapid shift, he stated flat out, Atlas remains effectively sold out for the second quarter. Think about that for a second. You simply do not sell off a stock when the CEO tells you they literally cannot mine their product fast enough to keep up with demand for the next 3 months. So this momentum builds a massive, massive foundation for Q2. The sand and logistics rebound is already well underway. Management highlighted that logistics margins, which plummeted down to the low single digits during those awful January freezes, had already decisively recovered to the mid-teens by March. Because of this quick bounce back, they are guiding for Q2 adjusted EBITDA to jump to roughly $50 million. That's nearly double the Q1 figure. On top of that, plant operating expenses are projected to drop to about $12.75 per ton. And if we look slightly further ahead into the year, up to 20 to 25% of their sand contracts could reprice in the second half of the year, which offers some really significant upside. But hey, as strong as that sand and logistics rebound is, it actually wasn't the main event of this earnings call. Not even close. The real plot twist here, the actual reason the market is so hyped, is Atlas's aggressive pivot into private power generation. To really grasp this, we need to quickly define 2 terms that totally dominated the call: the Global Framework Agreement, or GFA, and the Power Purchase Agreement, the PPA. A GFA essentially means you've secured physical equipment at a truly massive scale, which, by the way, is incredibly hard to do right now. A PPA is the contract where you actually sell that generated private grid power directly to a heavy load customer over a long period. Well, Atlas just secured both of these in a major, major way.
So the absolutely crucial point is this staggering figure right here, 1.4 gigawatts. Atlas signed a global framework agreement with Caterpillar, securing 1.4 gigawatts of natural gas reciprocating generator capacity. To put that into perspective, power generating equipment is currently in a massive, massive short supply globally. Everyone wants it. Atlas basically just jumped the line. By securing this equipment, they unlocked access to customers that were previously completely out of reach. This single agreement instantly jumped their commercial power pipeline from 4 gigawatts to an estimated 8 to 10 gigawatts. They are now squarely in the crosshairs for massive heavy load deployments like data centers.
And the best part? They aren't just hoarding this equipment. They are already putting it to work. On April 1st, Atlas announced their first 5-year private grid power purchase agreement for 120 megawatts. This deal is with a subsidiary of an investment-grade technology infrastructure provider. Once this initial 120-megawatt deployment is fully up and running, management projects it will generate $50 to $55 million in annualized adjusted free cash flow. Just think about that. A single power contract generating that much cash flow, and it represents just a tiny, tiny fraction of the 1.4 gigawatts they just secured. Now, of course, building a multi-gigawatt power empire like this requires some serious capital. And this brings us to a genuinely brilliant financial maneuver by the management team. They completely restructured their debt to fund this expansion. They took their old debt, which carried high single-digit interest rates, and paid a large chunk of it off by issuing $450 million in convertible senior notes at a rock-bottom interest rate of just 0.5%. Yes, you heard that right. In today's economy, 0.5%. They essentially refilled their war chest with incredibly cheap capital, walking away with about $386 million in net proceeds to go out and fund those massive Caterpillar equipment orders. And this whole multi-gigawatt power pivot, it isn't just about massive future data centers. It's actually happening right now out in the oil field. By utilizing their existing massive physical infrastructure footprint in the Permian Basin, Atlas expects to generate about $35 million in incremental adjusted EBITDA from smaller bridge and microgrid power deployments over just the next 9 months. They're smartly leveraging their current footprint to immediately deploy power solutions while the much larger grid-scale projects are still being built out. Let's map out this aggressive growth trajectory, what you might honestly call the Atlas transformation. Back in November 2025, they placed their initial 240-megawatt order. Fast forward to Q1 2026, they had already signed their first 120-megawatt PPA. By mid-2027, their target is to have over 550 megawatts of power fully deployed and running. And then we jump to the end of the decade, in 2030, where they are targeting a massive 2-gigawatt power portfolio. Executive Chairman Bud Brigham actually said he has never been more excited about an opportunity than what is occurring in the U.S. power markets right now. And clearly, they are moving fast to capture it. Which leaves us with a final, pretty provocative question to consider. With their sand and logistics business generating record volumes and acting as this incredibly powerful cash engine, and their power division rapidly scaling toward a 2-gigawatt portfolio fueled by cheap 0.5% debt, is Atlas Energy Solutions really just an oil field service provider anymore? I mean, if they execute on this pipeline, shifting from a cyclical commodity business into a utility-like cash flow engine, the profile of this company will be completely transformed. Are we watching the birth of a highly profitable, next-generation private power utility in real time? It's definitely something to keep a close eye on. Thanks for joining me for this explainer. Keep learning and keep watching the tape.